This guy was making $30 million a year for a literal bank deposit. I couldn't work out whether he was an absolute genius or a complete con artist, so I talked to him. I recently tried to buy a company that managed $1 billion, but when I looked at the books, I almost spat out my coffee. The manager was taking $30 million a year in fees to do absolutely nothing. If you've ever wondered why the rich seem to make daft financial decisions, this story will change how you think about value forever. I had been approached by a contact who wanted me to buy a fund business. My team had done the initial due diligence on this multifamily office. 10 families, roughly 100 million each. I expected to see some complex hedging, a well-diversified portfolio, or some proprietary trading pattern. Instead, I found a bank account. The entire $1 billion was in cash, in a bank account. It was earning 4 to 5% interest from the bank. The fund manager kept the first 3% as his fees and gave the families the remaining 1 or 2%. This guy was making $30 million a year for a literal bank deposit. I couldn't work out whether he was an absolute genius or a complete con artist, so I talked to him. And he said something that was a really important lesson for me. Those 10 families had one rule: make money if you can, but never lose money. To most of us, 30 million is a fortune. To those families, 30 million was the insurance premium they were happy to pay for certainty. It was a rounding error on their fortune, and they weren't paying for overperformance. They were paying for someone to be the steward and keep their money safe. A few years earlier, he had been earning them 8%, but as the markets shifted, he decided that was too risky and moved it into cash in the bank. This is the grown-up lesson most entrepreneurs miss, and something I've been very guilty of in the past. We assume everyone wants what we want. We assume everyone wants more growth, more profit, more speed. But at a certain level of wealth or corporate seniority, people stop buying growth and start buying peace of mind. In my M&A business, Unity Group, or when I'm placing directors through the Veblen Director Program, the biggest deals aren't usually the ones with the highest returns, they're the ones with the highest certainty. Those are definitely the easiest ones to close. If you're struggling to close a deal or get a board seat, you're probably pitching outperformance. You're telling them how much better you are than the competition. Instead, try pitching safety. Ask yourself, what is the certainty my client is willing to pay a premium for? What is the worst case scenario if they go with you? If you can give them peace of mind, then everything after that is upside for them. Now, sadly, I didn't get to buy that fund. Somebody else pipped me to the post. But that 30 million lesson was worth more than the deal itself. Well, maybe not, but it's still an important lesson.